Hi, and welcome to another edition of Coffee with Brendan. Today's episode, we're going to talk about something that some of you will think is very fundamental, and you already know that, and you'll say, oh, I can skip this one. But others, this is a question that you may have always wanted to ask and always have a question about, but never really found a good answer to it. And it is the difference between what is a Roth IRA and what is a traditional IRA. So let's jump right in. I got a little side-by-side chart to show that may help with this. So let's make that a little bit bigger here. And on the left side, you have the traditional IRA. On the right side, you have the Roth IRA. So with both of these in 2022, the maximum that you can put into is $6,000 and $6,000, unless you're age 50 or older, and then you can make a catch-up contribution of $7,000. Assuming that you actually have the right income thresholds. And so with a Roth IRA, you just cannot make a contribution to a Roth IRA if your income as a single person is over $144,000 and as a married person over $214,000. So I've had a couple clients the last couple of years where they started making contributions to Roth IRAs, but then because of a bonus or something that happened, they actually exceeded those thresholds, and you have to actually pull the money out if that was to happen. So bottom line is 144 and 214, those are the thresholds where you cannot make any contributions, period, in that tax year to a Roth if you're making that kind of household income. And then it starts phasing out at 129 and 204. But if you have less than 129 as a single person, less than 204 as a married person, you can make that $6,000 or $7,000 contribution. Now, just bear in mind that if you split this, where you say, I want to put some money into traditional, some money into Roth, it all adds together. So if you did make if you were planning on making a contribution to a Roth, it is reduced. Those $6,000 and $7,000 maximum contributions are reduced by any traditional IRA contribution that you make, and vice versa. If you're contributing to a traditional, then the Roth IRA reduces that. So that is contributions to a Roth. With a traditional IRA, it's a little bit different. What it comes down to is if you do not have any kind of retirement plan at work, whether it's you or your spouse, it really doesn't matter how much money you make. You can still make a traditional IRA contribution that is deductible. And that's a very important thing, especially if you're in one of the top tax brackets. But if either one of you or your spouse actually are covered by any kind of retirement plan at work, whether it's a SEP IRA, a 401k, a 403b, just about any what they call ERISA type plan, there is a limit to how much money you can actually deduct and what kind of how deductible your contribution actually is. So long story short, if we're looking at 2022, if you're making over $78,000 as a single person and you have a 401k at work, or you're a married person and making over $129,000, and either one of you or your spouse are have a retirement plan or 401k, 403b at work, you can make a contribution to your IRA, but it won't be deductible. You won't get a tax deduction for that $6,000 or $7,000 that you put into that. And we'll talk about that in a moment, why you would still take advantage of a traditional IRA, but use non-deductible dollars to do it. So the federal tax treatment is where these two really diverge. And I half-jokingly say that a traditional IRA is kind of a deal with the devil, whereas the Roth IRA is the opposite. What I mean by that is with a traditional IRA, the investment growth and contribution, the investment growth is tax deferred, and any contributions that you make are tax deductible, which means that you don't have to pay tax today You even get a tax deduction today, and then over the 10, 20, and 30 years that you may be contributing to, or you may have that traditional IRA, you don't pay tax on dividends, you don't pay tax on interest, you don't pay tax on capital gains. So for a long time, you may not have to pay any tax whatsoever on that, but it doesn't go away. And so that's the key. And we talked about this in another coffee with Brendan, with required minimum distributions. At age 72, you do have to take mandatory distributions. And for some clients, that can really mess with them because, number one, if you're taking out these contributions and that is considered income, your income could, in some cases, double and maybe even triple, from what you are making, and therefore put you into a different tax bracket. Furthermore, the tax code is littered with all of these, if you make this much money or that much money, you're not eligible for things. Most recently, the COVID stimulus checks were based on what your income was. And so for people that have to take these tax deductible deduction or withdrawals after age 72, in some cases disqualified them from receiving any kind of stimulus checks. Further, after age 72, if you make too much money, your Medicare may go up. So that's the challenge with this, is that for a long time, you don't have to pay tax. You think this is great, and you even get a tax deduction up front with the traditional IRA. But at age 72, you actually do have to start taking some money out, and it could really mess with your tax planning. The Roth IRA, and the reason why it's the opposite of the deal with the devil, so I guess I deal with the angels, it's the exact opposite. You can take as much money out of your Roth IRA. You don't have to take any mandatory withdrawals, and all that money's tax-free. It doesn't impact your taxes whatsoever. So if you do have one of these Roths, you don't get any kind of tax deduction, and whatever you put in is after-tax money, so no tax deduction, but all the money that you put in and any future growth that you have with that Roth IRA is tax-free. And so those are pretty important things. And then the last thing here, you have until tax time to make that contribution. So in 2022, it's April 15th, 2023. So I hope this was helpful, real short and sweet. This is the difference between the two. Traditional IRA, tax deferred, not tax-free, tax deferred. You're kind of kicking the can down the road. Roth IRA, tax deferred or tax-free. A lot of times I tell clients who have kids that are just starting to make some money at their job, that they really should be looking at that Roth IRA. So I would strongly recommend taking a really strong look at the Roth IRA, especially when you're in the lower tax brackets and a tax deduction from the traditional IRA isn't worth as much. The Roth IRA for that future tax growth, tax-free growth, is really important. So again, hope this was helpful. Hope you have a nice weekend, and we'll see you next time. Thanks.